Good afternoon. Thank you for standing by and taking the time to join us for today's webinar, State and Local Tax Considerations for Nonprofits. My name is Nicole Meeks, and I'll be your moderator for the day. Before we get started, I'd like to cover a couple housekeeping items. If you experience any technical difficulties, please dial 1-800-263-6317. A Q&A session will be held at the end of the presentation. Your questions can be submitted via the questions function located in the upper right-hand side of your screen, and questions will be answered in the order they came in. The link to the recorded presentation, slides, as well as if you've requested CPE, the CPE certificates, will be emailed to you within the next 10 business days. And finally, we invite you to fill out a survey that will pop up at the end of the webinar today. Your feedback helps us build strong programs for the future. For those of you who may not be familiar with us, CliftonLarsonAllen is a top 10 accounting firm. We are structured to provide clients with professional industry insight. The firm delivers its audit, accounting, tax, consulting, and advisory capabilities from industry-specific perspectives. CliftonLarsonAllen has staff of more than 3,600 professionals serving clients from more than 90 offices across the country. With more than 50 years of experience in the nonprofit sector, we have one of the largest nonprofit practices in the country. We serve a wide variety of clients, including associations and membership organizations, foundations, higher education institutions, religious organizations, and social service organizations. I'd like to introduce today's presenters. Our first presenter, Karen Grease, is a partner with CliftonLarsonAllen. She provides tax compliance and consulting services to exempt organizations. She has 25 years of public accounting experience, focusing on serving the needs of exempt organizations. Our second presenter, Ellen McCabe, is also a partner. She provides multi-state tax services to the firm's clients in all areas of state and local tax, including income franchise, state and use, tax incentives, employment tax, unclaimed property, and personal property. And last but certainly not least is Mike Harrell. Mike is a principal that provides services to the firm's clients in the areas of state business, income and franchise tax, sales and use tax, unclaimed property, and personal property tax. At the conclusion of today's learning session, you'll be able to understand some of the complexities related to state and local tax, Nexus, and how it applies to nonprofits. Understand general income tax concepts for nonprofits. Understand general sales and use tax considerations for nonprofits. Be familiar with the state registration requirements related to solicitations, and consider unclaimed property reporting requirements for your organization. So with further ado, I will pass the microphone over to Karen to get us started today.
Thank you very much, Nicole. And thank you for everyone for joining us for this session. You know, as we are a tax-exempt or as a tax-exempt organization, the question that we many times ask, why are we concerned about state tax? Or even if we say as a nonprofit corporation, you know, why are we concerned about state taxability to us? The answer is that when we talk in terms of nonprofit or tax exempt, the term or the definition is not one and the same. We may be a not-for-profit organization, you know, organized as a not-for-profit corporation, or exempt from income taxes from a federal perspective, but each state itself has different rules and requirements as it relates to the taxation of exempt organizations. And understanding these rules, the complex filing requirements, is really critical to your organization in ensuring compliance in this area. State and local considerations, once we do know that we have a situation where state or local tax may be a consideration, what we want to ask ourselves is whether or not we have enough of a connection to the state. Do we have Nexus that would allow the state to impose income tax upon our organization? And if the answer to that question is yes, then we have to further ask ourselves as far as what exemptions may apply for state purposes. Sales tax. If we have Nexus in the state, are we exempt in that jurisdiction from having to collect and remit sales tax? The same would hold true for income tax, franchise tax, gross receipt taxes. Again, just a litany of different taxes that as a not-for-profit organization or a tax-exempt organization, we do need to be concerned about. In addition, there are other compliance requirements that we must give consideration to. The registration for charitable solicitation purposes, unclaimed funds that Mike Harold will speak of later, and then other miscellaneous filing requirements that are within the states. Today's presentation does not address payroll tax compliance within the states. So again, if you have employees in other jurisdictions, we will not be addressing the payroll tax compliance because that could be an entirely separate presentation or webinar. If you have gone through our prior webinars, you'll know that for CPE purposes, we are required to hold polling questions throughout the presentation. So now we'll go to our first polling question and take a moment for you to answer. Our question of the day is really asking what your role is within the organization you are representing. So if you could, as I said, take a moment, answer the question, we'll accumulate results, and be back with the answer. And as we suspected when we were putting together the presentation, I'm assuming that the vast majority of the individuals on the presentation or during listening to the webinar are those individuals responsible for perhaps the tax compliance within your organization, serving in that financial role. And with that, I will turn it over to Ellen McCabe that will address state tax nexus and income tax considerations.
Hello, my name is Ellen McCabe. I'm going to spend about 25 minutes or so covering nexus considerations, and more specifically, income tax nexus considerations. We'll then spend some time discussing what income or franchise-related taxes may apply if your organization does have nexus. And then finally, we're going to cover, really just the basic computation of income tax. But we're also going to get into a little bit of the nuances around how you split that income tax between the various states for your organization, and talk a little bit about maybe where you can save some real tax dollars based on the different nuances in those laws. So where do we begin? You should approach it first by finding out where the organization has nexus. That's really the first step. You need to determine what activities are taking place and what's creating nexus for the organization. Once this is done, you need to determine what taxes can be imposed on the organization. And this means a total evaluation of all taxes and fees. You have sales tax, income tax, franchise tax, gross margin, payroll taxes, miscellaneous fees. There's recycling surcharges and litter taxes, etc. The list is never ending, and the states are constantly changing this and adding little taxes, especially when you get into your local jurisdictions. So it's really important to understand what all the taxes are out there. When you get into the nonprofit world, not all these taxes are going to apply to your organization. And that's why it gets even a little more tricky, because you have to really dig in and find out where there are exemptions and how to avail yourself of those exemptions. And that's really where we get to point number 3. Often there is a need to register as a nonprofit or apply for a separate state nonprofit determination. As Karen mentioned, Nonprofit and tax exempt are not the same at the state level. Just because for federal purposes you're an exempt organization doesn't necessarily mean that the state will follow that. And then the last part of the analysis is really to figure out how are these taxes or fees computed. And you'd think this would be pretty straightforward, but remember, we're dealing with taxes, so nothing's really ever straightforward. And we'll get into this more later, but generally it's not as simple as putting numbers on a form. I know a lot of times people will say to me, oh, you know, you can just spit out the state returns because you've got a federal return and, you know, it's just going to feed off of that. Well, it's really not that simple. There's a lot of underlying nuances to the rules when you get into how to split these numbers between the various states. So what is Nexus? Well, very simply, Nexus is the amount and degree of business activity that must be present before a jurisdiction can tax your organization. The underlying concepts for Nexus are all constitutionally based, with most of the case law analysis focusing on the due process and commerce law. The due process clause analysis focuses on whether there's a minimal connection between the interstate activities that are taking place and the taxing state. And you'll see in more recent case law, the interpretation of what is this minimal connection is very minimal. I mean, it's very slight. Basically, if you think about a state, you know, that almost gets you to the point where you have a minimal connection with the state. Now, I'm being a little sarcastic, but it is very, very slight amount of activity that can create, that passes that test. This analysis focuses really on whether the tax on the income or activity is justified by the protection that or opportunities or benefits that state is providing. You know, really it's looking at, are you getting something from the state that allows them to impose a tax on you? And again, this is interpreted very broadly. The Commerce Clause, on the other hand, is meant to protect the free flow of commerce. And that does have a concept around, you know, that there has to be a substantial connection. Substantial, again, is not really well defined. Are the slides moving for the audience as well? They just kind of moved on their own, so I wasn't sure what. I apologize for that. I'm not sure what happened there. Okay. I think we're back on track here. Sorry about that. So there's Constitution and there's federal laws as well. There are federal laws out there that provide an exemption from taxation when you're selling in interstate commerce, but these laws really are not pertinent to this audience, so we're not going to go into any of the details on these. But there are constitutional and federal rules related to Nexus, and the interpretation of these are not really clear. And to add confusion to all of this, the interpretation around these laws are different for each type of tax. So what we know that for sales tax, physical presence is required. Now that physical presence can be a third party, it can be an affiliated party, you know, and now today, even if you have some of the states have like click-through provisions. When you click through on a website and there's a commission arrangement, that is considered a physical presence. So, you know, again, this interpretation around physical presence isn't just your employee or your property in a state. It is an expanded type of physical presence. On the income tax side, we know physical presence creates Nexus, but what we don't know is what beyond that creates Nexus. The states have broad provisions, and they have this concept of economic Nexus, and that can create a tax as well, or give the states the ability to impose a tax. On the franchise tax side, again, typically physical presence, but you know there's a lot of room there. The bottom line is the states are getting very, very aggressive. They're testing the waters, and they're really expanding their Nexus provisions. They realize that the more they can pull into the state, and with companies and organizations operating on a multi-state basis, that they can really, you know, use these Nexus provisions to pull people in and subject them to tax. With that, let's take another polling question. if you want to take a few minutes and fill this out, then we'll let you know what the results are. What compliance areas do you believe are the most challenging to your organization? Sales and use tax, unrelated business income tax, state charitable solicitations, property tax, or other? So it looks like we have some results here. Sales and use tax, 25%. Unrelated business income tax, 37%. State charitable solicitations, 27%. Property tax, 4%. And other, 7%. And that seems to make a lot of sense. I would think property tax wouldn't be a big issue for the audience. So those results definitely are in line with where I would think they would be. So what is economic nexus? Economic nexus is really what this concept that I talked about that's broader than physical nexus. So with economic nexus, the states are looking at whether you have a purposeful direction at that market. Are you deriving some kind of economic benefit from that market? The statutes that the states have put in place are very broad, and they have this kind of economic nexus language. Because these statutes are so broad, it's really important to understand that you don't necessarily need physical presence to create nexus. In fact, some of the states have even taken this a step further and have imposed bright line standards that will result in nexus if the organization meets certain dollar thresholds for the amount of property, payroll, or sales that are in that state. And these thresholds are generally fairly high, so they may not typically apply to most of the people on this call or webinar. But it is important to know that there are about 6 or 7 states out there that have these bright line standards. One of the states that we see a lot of organizations operating in is California, and California does have a bright line standard that went into place in 2011. And that's if you sell more than $500,000 or have more than $500,000 in gross receipts in California, if you have payroll of more than $50,000 or 25% of your total payrolls in California, or if you have property of $50,000 or 25% of the organization's total property is in California. So you can see while the thresholds are fairly high, that 25% criteria could sneak up on you. So it's just important to keep these bright line standards in mind. So we've talked about the fact that the states can tax you if you create nexus. So what types of activities do we see typically create income tax nexus for nonprofit organizations? Well, here's a few examples of them. Professors that are conducting online training, there's a lot more of the online education courses or training courses taking place, and often this is done from an out-of-state home office or a satellite type location. That would create nexus for your organization in the state outside your home state. Editors of a trade publication that are working from their in-home office. And trade publications gets really complicated because there's a lot of complex rules around nexus when you get into trade publications. Well, actually on the sourcing rules around trade publications. But if you had editors sitting in another state, that could create nexus for that organization. Travel outside of one's home state to run or participate in charitable functions, that too, can create nexus. And we'll talk in a minute about, what substantial nexus So, again, these are the types of activities that create Nexus. If you do it one time, would it create Nexus? That's an analysis that would have to take place. Some other things there's some other activities that might create Nexus are speaking engagements, having, individuals on a research assignment in another state, the development officers travel to various states. These are all examples of the types of activities that could create Nexus. Now, as I mentioned, so you go to a state one time. Does that create Nexus? Well, there is a concept on the income tax side that, and on for all taxes actually, but there is a concept of substantial Nexus that I talked about before. And on the income tax side, what is substantial Nexus is not defined. We do know that the number of trips or number of days outside one's home state isn't how you would evaluate that. There is a de minimis concept, however, and when you analyze this, you need to look at whether the activity is regular or systematic and whether it's related to the organization's overall purpose. So if you went into a state, say 2 times a year, but it was regular, systematic, part of your purpose, that may create Nexus, and a state may argue that that is substantial Nexus. However, if you went into a state one time, it was a one-time deal, it was something that was out of the ordinary, that's the type of thing that you would argue, well, that's really de minimis. That really was not substantial. So once we've determined that we have Nexus, the next step is to determine what taxes apply. As I mentioned, just because you're a tax-exempt organization for federal purposes doesn't mean that the states will necessarily accept that. I mean, most of the states will accept a federal tax-exempt status under 501, under Section 501. However, many of the states will require a separate registration or determination in order to receive that tax-exempt status at the state level. Most states will subject the unrelated business income to tax. Franchise and taxes on capital generally will not apply if you're tax-exempt for state purposes, but again, that's a generalization because we're talking about, a broad number of states. For example, California, in order to be tax-exempt for their income franchise tax, Form F, if presuming you are federally tax-exempt, you would file Form FTB 3500 to get the California tax exemption. And again, just as you would pay tax on the federal unrelated business income, income tax would also be imposed by California. North Carolina, foreign organizations have to register with the Secretary of State. They have to get a determination letter to be considered tax exempt. And again, income tax will apply on the unrelated business income. However, franchise tax will not apply if the organization is exempt. So we now have looked at, do you have Nexus, and then which taxes would apply. So now we're to the point where we need to compute the tax on the unrelated business income. The unrelated business income, if you're operating in a multi-state environment, has to be split between the various states. Income's apportioned amongst the states using a percentage of the organization's in-state activity versus their out-of-state activity. A quick slide just to depict how this is done. You take your unrelated business income. There's often state modifications that come into play. So, they might not just take the straight out federal unrelated business income. They may have some state adjustments to that. But then you times that by your state apportionment factor. That gives you your state apportioned income. You times that by the applicable state rate, and that gives you your unrelated business income tax. So with that, let's take another polling question. What type of revenue generates unrelated business income tax for your organization? Advertising revenues, alternative partnership investments, sales of merchandise or services unrelated to your mission. Our organization does not generate unrelated business income. And take a few minutes to fill that out. Thanks. Okay, we have an answer for our polling question. We've got 19% that are related to advertising revenues, 12% related to alternative partnership investments, 22% related to the sale of merchandise or services unrelated to your mission, and then 48% do not generate unrelated business income. Great, thank you very much. So getting back into the computation of the income tax on the unrelated business income, we talked about the apportionment factor. The apportionment factor that is utilized will be the in-state property payroll and sales that generated the unrelated business income divided by the organization's total property payroll and sales that generated the unrelated business income. And that's a generality. Every state has modifications to that factor. So some states do include all three factors and they equally weight them. Other states will weight certain factors more than another. Today, most states' apportionment factors are more heavily weighted on the sales factor. And we often see that 100% sales factor is used in determining the income that is apportioned to a state. When you're looking at the apportionment factor and you have to figure out what's going to go in my numerator and what's going to go in my denominator, the numerator being the in-state property payroll or sales. So when we look at the property, we source the property to the numerator based on the state where the property physically resides. Rent expense is also included in there, and they go through this odd calculation where you capitalize it at 8 times the total amount. Payroll, then, is sourced to the state where the employee is performing the services. Generally speaking, the states audit the payroll numerator to the employment tax report. A lot of states specifically say in their audit guidelines that they're going to tie out to the state unemployment report. So a safe bet is to use, to tie to those reports. The payroll factor and the property factor are pretty straightforward. However, the sales factor, on the other hand, is nothing, is not straightforward, not anything near straightforward. Generally, states will source the receipts from a tangible property to the state of final destination. And that piece is pretty straightforward. But where it gets tricky and where it would apply to a lot of the people on this call is that the receipts from services are sourced using a methodology that's called either cost of performance or market approach. I know you're saying, what the heck does that mean? We're going to get into that some more here. Cost of performance is where you look at where the underlying cost of that income-producing activity occurs. So, for instance, if the organization is located in Minnesota, and all the personnel are located here, and there's really very little activities taking place anywhere else, then the underlying cost of performance related to the income-producing activity is most likely going to be Minnesota. The market approach looks at where the customer is located or where the benefit is received. So you're looking at, who's receiving the ultimate benefit, who's the party that is receiving the services. It's really looking at the end person, the end user, end consumer kind of approach. The difference in these sourcing rules can be pretty interesting because it can end up in a sale being sourced nowhere or being sourced to 2 states, or maybe more states, actually. The determination of the receipts by state, we're going to go through an example here. Let's assume a trade association publishes a newsletter, and it has unrelated business income from advertising revenue associated with the publication. So let's take a minute here and just walk through where would those receipts be related to the advertising revenue be sourced. Well, if we're looking at cost of performance, the sourcing would be where the underlying work is being performed. If the state that we're looking to source the revenues to has a market approach, then the sourcing is the end cut. Then you would look at where the end customer is located. And this is often really just where the subscriptions are going. Some additional facts. The work's all performed in states that follow a market approach to sourcing revenues. And the publications are all being shipped to a cost of performance state. So where the organization is located, they would not source the sale to their state because they're looking at a cost of performance approach, or they're looking at a market approach, so they're looking at the end result. So you end up with a sales factor numerator that's 0 because, again, your headquarter or your organization where it's located, they're going to source revenues based on where the market is, and the market state would source revenues based on cost of performance. So you literally could have a 0 numerator and a 0 factor. However, this also could come back to haunt you because these rules can also result in double taxation. So, keep in mind that the overall tax liability can be greatly reduced by taking advantage of these different apportionment mechanisms, but you have to also be careful because they can flip on you and you can end up with some bad results as well. So what does this mean for your organization? Well, as we talked about in the beginning part of the presentation, it's really important to get your hands around where your organization has Nexus. Oftentimes when we speak with clients and we talk about, what's taking place, they're not aware that the various activities that their employees are performing or that they have a third party performing on their behalf can result in Nexus for the organization. So it's really, really important to understand the activities that are going on and match those up against what are the state rules regarding Nexus. Secondly, you need to understand the administrative requirements of the states. So, oftentimes we'll talk to a client and they'll know that there's certain state exemptions out there for federally tax-exempt organizations, but they may not be familiar with all the registration requirements or the hoops you have to jump through in order to really avail yourself of those exemptions. So again, extremely important to just stay on top of these areas so that you can make sure you don't have surprises down the road. Nothing would be worse than finding out 3 or 4 years down the road that there was an exemption out there you could have had, but you didn't file the right paperwork in order to avail yourself of it. Thirdly, you want to make sure your tax on unrelated business income is being handled properly. There are opportunities to reduce tax. We just walked through an example where just because of the way the apportionment formula is working based on sourcing rules that the states have, you can have some pretty good results. Oftentimes, I think people, again, just think the forms are going to fill themselves out and, they take kind of a quick approach to it. It's really important to understand these underlying rules because there are opportunities to reduce your tax. And then you also need to continually monitor these rules because, as we know, the states and the local governments are really hurting for dollars. And so, there's constant changes to the tax laws, and even in different interpretations around, laws that are in place, all of a sudden there'll be a regulation interpreting it differently that has a big impact for your organization. So it's really important to stay on top of these items. With that, I'm going to turn it over to Mike Harold. We're going to wait and hold questions until the end of the presentation, but I'd be very glad to take questions at that point in time. Mike, it's all yours.
Thank you, Ellen. We're going to talk about the sales tax impact on nonprofits. And I know earlier you said it wasn't a big issue, but maybe it will be. We don't want to scare you, but it is something that's coming up more and more. States are aggressive, looking for money, just like Ellen mentioned. And sales tax is a big source of revenue for a lot of these states. And I think what organizations have to be aware of is, what is your status? Just because you're a nonprofit doesn't mean just because you nonprofit takes on several different meanings. It depends on your perspective. A nonprofit organization from the IRS means that basically you have no federal income. A nonprofit organization's viewpoint is, I'm tax exempt. The state's viewpoint is, okay, you have no income except for your unrelated business income, but there's going to be possibly limited or no sales tax or property tax protections. The states look at this differently. Just because you're a nonprofit for federal purposes does not mean you're a nonprofit for state purposes, particularly when it comes to sales and use tax and also property tax. Property tax and sales tax go hand in hand in many jurisdictions. So again, it depends on your perspective. What are you looking at? What is your viewpoint? So this presentation is looking at it from the state's perspective. The number one rule for all states, the entire basis for sales tax is sales of tangible personal property are taxable. All sales of tangible personal property are taxable with some exceptions. Then when it comes to services, some services are taxable, some aren't. Depends on the state laws. So you have to look at that. So when it comes from the perspective of nonprofits, are you selling tangible personal property? If you're selling tangible personal property, is there an exemption for those sales of the property? If you're selling clothing, does your state have an exemption for clothing? If you're selling food, is there an exemption for food? If you're selling prepared meals, is there an exemption for prepared meals? There's a number of different categories that it falls under, and you have to understand what the state law is looking at as far as what is exempt. The other question is whether your organization is exempt. Are you required to collect tax on those exempt sales? And again, that goes back to your nonprofit status and if the state recognizes this exemption. Some states will simply recognize it if you're a 501c3, and others won't. We're getting more details in just a moment. For nonprofits, the states, they're saying if you have a nonprofit exemption and that they exempt nonprofits, your purchases are going to be exempt. But again, we've got to see, does that mean all purchases or only purchases that are used in fulfilling your charitable purpose? Does that mean that it's going to be the computers and the software and so on that you need to conduct your business? Does it mean if you have a food shelf, is it going to be for the shelving for the food? Is it going to be for vehicles? Are you allowed to get an exemption for the vehicles? A number of different things we have to look at, and these laws are not standard. They vary by jurisdiction, state by state, possibly even different rules at a local level. So one of the questions that often comes up is a nonprofit required to collect tax on the sale of goods. And again, we have to look at the state exemption. Many states are saying you're going to be exempt if you're providing a charitable service. So when we look at the 501c3s or whatever type of organization, is it providing a charitable service? Is it relieving the burden of government? Is this a service you're performing that relieves the burden on the government? Those type of things are generally going to be exempt, providing the state has that exemption. Other charitable activities or other nonprofit activities may not be exempt. Maybe a nursing home, for example. That may not be exempt in many jurisdictions. You just have to look at it by state again. One of the tests that they use for charitable services is whether the products or service are delivered based on the recipient's ability to pay. And this goes back to where I was talking about nursing homes. Nursing homes, in many cases, are not considered tax-exempt organizations in states that use this broad charitable service exemption, because if you don't pay your bill, the patient is asked to leave. And that's one of the things that the states really are testing, and we're seeing more and more activity state or across the country on this issue. States have special state requirements for nonprofits. Some states simply exempt you if you're a 501c3. Other states are more broad, and they're allowing exemptions for other types of 501c or 501 entities. And some states simply refuse to honor the federal exemption without more action by the nonprofit. In a case like this, the nonprofit's going to have to apply for a tax-exempt status, and hopefully that the state are granted. Others require a special state application for sales tax exemption. Others simply allow no exemption at all for the purchases of goods or the sales of goods by tax-exempt organizations. So just because you're a 501c3, you can't assume you're exempt from sales tax. We do have a polling question. Take a moment to answer this question. What types of activities does your organization conduct outside of your home state? Conferences, remote workers, sales of products or merchandise, or other? So just take a moment to answer it. Okay, the results are in. So what type of activities does your organization conduct outside your home state? Other was the winner at 51%. Conferences, 22%. Remote workers, 17%. And sales of product or merchandise, 10%. I want to give you some examples here of what happens with some of the states and some of their viewpoints. Arizona and Idaho, they have no exemption for religious organizations. They're simply taxed in those states. So the purchase of products is going to be taxable. They're going to have to pay sales or use tax. Alabama, Arkansas, California, Louisiana, Mississippi have no tax exemption for 501c3 organizations. Illinois, Minnesota, Nebraska have exemptions only for those deemed to be exclusively religious, education, or charitable. Pennsylvania says must be a purely public charity. In many of these cases, you have to do an application to the state to determine if you qualify under their rules for these exemptions. This is important, especially when you look at that polling question where you have remote workers. If you have remote workers, that gives you Nexus in a state, and you're required to follow some of the laws in those other states. And that's one of the problems that we're having with kind of our global economy. People are moving around in different states. You may be a nonprofit soliciting funds in other states. You might have sales in other states through the internet and so on. And this creates an entire different set of rules that you have to live under as far as Nexus, and you have to collect tax. If you're a nonprofit exempt organization in Iowa and you have a remote worker in Nebraska and you're selling products over the internet, and because of this remote workers living in Nebraska, now do you have to collect Nebraska sales tax on any products or sales of your products that are going in Nebraska? Answer is probably, unless there's a specific exclusion. And that's what the environment we're living in today for tax-exempt or nonprofit organizations. Some states tax nonprofit organizations, and many of the states tax nonprofit organizations with some specific exemptions. So here, Alabama, they simply, no 501c organization is exempt. So again, if you somehow have established Nexus in a state like Alabama, and you're a 501 organization, you have no exemption. Any sales of your products into that state are going to be considered taxed. Arkansas, they have very specific exemptions that they list. So only certain organizations that fit within this statutory definition will be exempt. California simply are saying no 501 organizations at all are going to be exempt. Idaho, only no nonprofits that are specifically listed within its statute are going to be exempt. Louisiana is another state where no 501 organization is exempt. Maine has, again, specific statutory definition on what nonprofit will be exempt. Mississippi, again, is a state that has no exemption for 501 organizations. Same with North Carolina, no exemption for 501 organizations. Oklahoma is another state where it's going to have to be specifically identified in its statute to get the exemption. And Pennsylvania, we talked about, I don't have it on this particular list, but you must apply to Pennsylvania Department of Revenue, and the entity must be considered a public charity. Washington's on my list, and that exempts schools and other very specific groups. So you can see the rules vary significantly. So these are the states with some specific exemptions. Now these states have a little bit more favorable exemptions for nonprofit organizations. If you look at Colorado, they allow exemptions for 501c3s and other different 501 type of entities. You look at Connecticut, they allow 501c3s and 501c13 exemptions. District of Columbia, 501c3s. Indiana's got a variety of them for so you got 501c3, 501c4, and 6, and it goes on. So they have some very specific rules on who's going to get this favorable exemption. But generally, most of the states up here, we're a 501c3, you're going to get some sort of an exemption. Doesn't mean that you will get it just because you're a 501c3, but it means you can apply to the state and apply for some sort of an exemption and see if you qualify. They usually have very specific rules, and again, you can't assume because you're a 501c3 that you are going to be exempt from tax. And really, the importance of this comes up on what happens with your sales of your products. You know, sales by nonprofits, again, the state's considered sales of tangible personal property as being taxable, even though nonprofits may be required to collect sales tax on the sales of tangible personal property. Well, you may be required to collect sales, but there could be different exemptions. So you have to collect tax on the sales of your product unless there's an exemption. So it might be a fundraising exemption. There may be a de minimis sale. Maybe it's an item under $10 and you're going to sell $100 worth during the year. You don't have to collect tax in those cases. Maybe the product itself is exempt. Maybe it's you're selling food, for example, and it's non-prepared and it's going to be exempt. Just this morning I had a call from a local fire department, and they're doing a fundraiser, and they want to know, do I have to collect tax on the sale of my hamburgers, my hot dogs, my soft drinks, and my beer, and what about these other events that they're going to have? Well, the answer is generally there's going to, if you meet a fundraising exemption, which this fire department did, and they were a qualified entity, they don't have to collect the tax on the sale of the food. They don't have to collect the tax on the soft drinks. However, on the sale of the alcohol, they may have to. In this particular case, they had to, because a lot of times alcohol is under a different taxing scheme than sales tax. So you have to look very closely at what's happening, what is the activity, what are the things that you're selling. Look at colleges and schools, for example, with everything that's going on. What about the sale of textbooks? Textbooks are exempt in some states. Other states, books are tangible personal property, and it's a sale by a nonprofit, but it's a taxable sale. What happens when we're getting into digital publications and you're selling those books online? Are those going to be taxable when you're charging your students? Where do you tax your student when you're a college or a university and you have students all over the country, even though your campus might be located in Florida? Do you have to collect the tax in California in that case for your students in that state? Well, it depends. Do you have Nexus? Do you have some sort of a physical presence in the state? Do you have somebody going into the state recruiting on your behalf? Are you attending various trade shows to promote your school? Do you have professors living there that are conducting classes over the internet? Those types of activity might create Nexus. And in a case like that, then you may have a requirement to collect the tax. Again, there may be some exemptions. We have to look closely. The guidelines I'm giving today are just broad guidelines. What happens if you're an animal shelter? Do you have to collect tax on the sale of your cats and dogs and goldfish? In many states, that's going to be a taxable event. Your purchases to buy the cages, the dog food, the veterinary care, those might be exempt if you're a qualified entity, but the sales of those animals, they're considered tangible personal property. They may be taxable. I know there's an animal shelter that I've been dealing with, and they're probably going to go bankrupt because the entire time they've been in existence, they haven't collected sales tax on the sale of the pets. What about if you're a public radio? You know, we always see the member drives, or we hear the member drives on public radio, public TV, and if you donate $300, you get this collection of CDs. What about the purchase of those CDs? What about, do you have to charge tax when your member is contributing and they're giving CDs? Typically in a situation like that, the CDs aren't being sold, so there is no tax consequences on the sale piece of that. You're giving that as a gift, and gifts generally aren't taxable. So what happens when the public TV or public radio, they acquire these CDs? Do they have to pay use tax? Because they're not going to keep them. They're going to give them away as a gift. Generally not, because that's part of their charitable activity. It's part of their fundraising. And in many cases, those wouldn't be taxable. Again, we have to look at each state and determine what rules apply. But what happens then if you're doing it in multiple states? You have to look at different states that you're in. What happens if you're doing a fundraiser, you're an organization located in D.C., and you have people conducting fundraising activity for you around the country? Is that something that's going to be a taxable event? Depends on the product and depends on these other state laws. Now, they're representing your organization in another state. They're creating a market for you. The activity's regular, systematic. You may have Nexus, even though your headquarters is in D.C., but you got people acting on your behalf, conducting fundraisers. That might create Nexus, and you might have a sales tax obligation in a number of different states. What about youth programs when you send youth to help out in poor areas in different communities or different states? Is that going to create a presence for your youth organization? Again, that may, and you may have to fall underneath the sales tax laws of that state and see if you do have an exemption, and maybe the products or the services are going to be taxable. A lot of times, we end up in a situation where fundraisers are buying food, catered food, prepared food. Is that going to be a taxable event? Generally, catered food is taxable, and your exemption does not apply to catered food, prepared food. If your organization goes to a restaurant, you have to pay tax. You're usually not allowed to get an exemption on the purchases of the food. Now, if you're taking that food and you're selling it at a fundraising event, often you can buy that food exempt, give the caterer an exemption certificate so they don't have to collect tax from you, and then that's part of your fundraising activity and maybe no tax applies. Again, we have to look at each state. Fundraising is really a tricky issue, and the laws are pretty complicated in the states. Any fundraising event Some states have a maximum number of fundraisers you can have during the year. Some have a maximum dollar amount. There's all kinds of issues. And it becomes even more complicated if you have multiple tiers underneath you, the nonprofit organization. So nonprofit purchases are presumed taxable unless a specific exemption exists. And the most common exemptions for the purchase of goods used in charitable purpose. So your software, office equipment, furniture, supplies are generally going to be exempt as long as it's part of your business that's used for charity. Exemption certificates should be issued to suppliers where appropriate, and you can't assume, because there was no tax on an invoice, that the product is exempt. You have to make that determination yourself. If you're audited by sales tax auditor, they generally end up assessing on use tax. Use tax usually makes up the biggest piece of most sales and use tax audits. So you really have to look at this closely and have good documentation. The area that we find right now on sales tax audits, and this applies to every entity, whether it's nonprofit or not, is the use of credit cards. You can use a credit card, you can go out and make purchases, but again, that doesn't show if you paid tax or not. If you're relying simply on a credit card statement, you actually need that original invoice. So, for example, you have somebody in your office go out and buy a computer at the local office supply store, and they use a credit card. You don't know if tax is charged or not. If you're simply booking everything off a credit card statement, you need that original invoice to show if tax was applied or wasn't. And again, maybe because you're exempt status, it's not an issue, but you still want this documentation in place. You know, the questions to ask when you're doing business in a state: do you have Nexus in a state? You know, this is something we've talked about multiple times here. Do you have Nexus in the state? Do you have somebody physically present in a state, either temporarily in a state? Are they in the state for 5 days? Is it somebody who's representing your organization at a fundraising event? If you have Nexus in another state, a physical presence in another state, and again, it doesn't have to be for every day of the year, it can be just temporary presence. If you have someone in the state that's created Nexus. If so, now you have to start looking at the sales tax rules. Are you required to specifically apply for the sales and use tax exemption in that state, to be registered for an exempt organization? Then what are the limitations of the exemption? Are you allowed to, you have to follow that state's rules. Are the purchases used for exempt purpose? Are the sales of tangible personal property or services going to be taxable? What about a fundraising exemption in that state? The filing requirements for subsidiary or disregarded entities, intercompany transactions. You have to look at all these things. You can't ignore those issues. This is the problem that we're finding nowadays with nonprofits. They're becoming global. They're going across the country. You can't rely on your home state's rules. You have to look at the other rules where you're conducting activity. Another thing what happens is nonprofits assume that a financial audit is going to detect any sales tax issues. That's not the purpose of a financial audit. The financial audit isn't looking at the sales tax, whether you're doing the sales tax correctly, whether the taxability decisions are being made correctly. These are all things that are outside the scope of a financial audit. You know, it's something that can be added to it, but it's not a part of the financial audit. So you have to be aware of that. You can't rely on the financial audit. And again, these rules change constantly. So you always have to be up on the rules, what's happening in the states. The states are aggressive. They're hungry for money. We got internet transactions going on. States are trying to close all these different loopholes, and they are looking at nonprofits. One of the reasons they're looking at nonprofits is because not only is our state governments hungry, but local governments are hungry. Local governments get their money from property taxes. Property tax and sales tax exemptions go hand in hand in many jurisdictions. If you're exempt for sales tax, you may be exempt for property tax. Now auditors, or assessors rather, are under increasing pressure from the local governments to try to get the maximum tax dollars out of the property within their jurisdiction so that they can fund the local police services, the fire departments, and everything, all these other services that are required of municipalities, because their state funding is being cut. So the assessors are going in there with a keen eye, and they're starting to look, are you really qualified for that exemption, that property tax exemption you've been having for years? Assessors can no longer be charitable. They have to follow the rules. They're being held accountable. So the property tax exemptions exist for nonprofits who qualify for sales and use tax exemption in some jurisdictions. And the states are becoming more diligent, putting more pressure on these assessors to look at it. One of the things that we find out is maybe a property is exempt, but it's also got some other agency or for-profit organization in there. A hospital would be an example. You have a hospital, it's going to be an exempt institution in a certain specific state, but they have a flower shop. It's a commercial activity, or a drug shop or a drugstore in there, and that's not a part of the hospital. Those are commercial activities. That piece of the property should be assessed the same as any other commercial property. So these are issues that come up. Maybe it's a nonprofit that's on the second story of a commercial building, and you have to pay property tax. Maybe it's going to be prorated. So we do have different issues that arise in the property tax arena too. If a state comes out there and they find you're not qualified for the property tax exemption, they may yank your sales tax exemption. So you have to be aware of this. Record keeping. It's so important to have good records. This is really a key when it comes to sales and use tax. A sales and use tax auditor will come out there and go through all your invoices. They'll look at your payables. They'll look at your receivables. They're seeing if the tax decisions are being made correctly. They need that original documentation. You need clear record keeping to show that you're following the rules for the whatever exemptions might be available. Fundraising is really the key. If you have a fundraising, you need to have separate records. You need clear documentation of the fundraising event. If there's a specific number of days that you can have a fundraising, you got to track that. You got to understand what your purchases are for the fundraising events and what the sales are. Very clear paperwork. Sales should be monitored closely when products and services are similar to for-profit entities. It's the for-profit entities that get upset when somebody is hiding behind that veil of a nonprofit. And they're the ones that put the political pressure on the legislatures to really tighten the rules when it comes to nonprofits. We do have a polling question. Who within your organization is responsible for addressing state tax compliance? Is it the finance department, corporate compliance, or others? So who within your organization is responsible for addressing state tax compliance? Finance department, corporate compliance, or others? Okay, well, the winner is the finance department at 75%, followed by others and corporate compliance at 4%.
Thanks, Mike.
I do want to follow up on just one or two things here before I turn it over to Karen. This is really a big area, and sales tax audits are expensive. We easily see them in the six figures. For nonprofits, certainly in the five figures. It's something that you need to be looking at. If you have any concerns, you should contact somebody in the CliftonLarsonAllen office, and they can help. We can go out, we can review your tax decisions. We can make sure that you're correctly registered with the state. And this is so important if you're doing multi-state activity. One of the things you don't want is your name in the paper. And this is a way of avoiding that, is to be proactive, get involved, make sure you have your tax decisions under control. You want to make sure you know what is taxable, what the limits of the rules are, and they give you a nice solid foundation so in the future you're able to move forward and really just concentrate on your activity and your business. With that, I'm going to turn it over to Karen.
Thanks, Mike. So we've heard thus far in the session talking about sales or estate income tax, sales and use tax, property tax. Now we're going to turn it over to a topic that isn't necessarily a tax. This may be splitting hairs between what's a tax versus a fee, but we'll talk a bit about solicitation and state registration requirements. The charitable sector itself continues to be so very highly regulated, self-regulated, I should say. We know that the IRS has increased its role in regulating charities or the charitable sector with the redesign of the Form 990. The Attorney General's offices or state charitable officials have the role truly of protecting assets that are held within their state or making certain that assets are held and used for charitable purposes. They have the role of protecting the citizens within their states. If your organization is sending out a charitable solicitation to a resident within a state, a resident of the state of California, it's the California Office of the Attorney General that is looking to protect its citizens. As Mike and Ellen both indicated, states are becoming more active in regulating exempt organizations from an income tax or a revenue generation stream when we look at the different types of taxes. But state regulators are also looking at regulating exempt organizations that are, in essence, soliciting within their states. All 50 states and the District of Columbia regulate nonprofit organizations in some form or another. Some states are very active in regulating charities. There are some states that many times will use the term are very hypervigilant in regulating their charities. The state of California, state of New York, Massachusetts, North Carolina. When we look at states, 39 states and the District of Columbia have laws that govern charitable solicitations or registrations or licensing of exempt organizations. So again, all states will in essence regulate not-for-profits in one fashion or another, but there are only a limited majority of the states, but a limited number that govern our charitable solicitations. Who must register under charitable solicitation laws? It's really the nature of your activities combined with the laws in the state that really says or determines who must register. If you have a solicitation that's for charitable contributions, again, an ask for a charitable contribution, or perhaps an ask to support the program service activity within your state. If that is done through our traditional mail, if it's on the internet, if it's through a Give Now button or an interactive website, which we all have interactive website in today's world, if it's a phone bank or phone solicitations, utilizing a professional fundraiser, perhaps social media. Do you utilize Facebook, Twitter, LinkedIn by way of the manner of garnering additional contributions? It was interesting when I attended the National Association of State Charitable Officials, their NASCO conference last year. There was a very, I'll call it a spirited discussion, seeing where the states are all over the board, and many times themselves not really certain how to recognize or regulate social media in today's world. Mike talked a lot about fundraising events. The same fundraising events that do, in essence, trigger perhaps sales tax considerations may trigger charitable registration considerations if that fundraising event is held outside of your home state. Again, assuming that you are registered within your home state, but if that event is held in another state, even if done by volunteers, if those volunteers are acting as your agent, it may trigger a registration requirement. The use of professional fundraisers also may trigger. And the other item to really keep in mind is the charitable solicitation requirements or registration requirements go beyond those solicitations that are done by 501c3 organizations. Depending upon the types of solicitations that you're conducting or how your organization is established, that may too trigger a registration within another jurisdiction. I many times will use this example just from the state of Minnesota that defines a solicitation or to solicit is really any request. And most states have adopted a definition very similar to this. It may be a request that's direct or indirect. It may be regardless of who initiates the contribution or the communication. So you may have a donor that comes out to you and indicates, I would like to give you, as an organization, a charitable contribution. And if you say yes, you accept the contribution, and you do initiate further discussions with that person, you may be required to you may be required to register in that state. With that being said, we'll have another polling question. And this is perhaps more of a true-false question. It is. The definition of a solicitation is a request directly or indirectly for a contribution. So if you could answer the question, true or false. And as we know, that is a true statement, that the solicitation itself can be made in many different manners. Going ahead in the presentation, why are we concerned, or why should the organization actually register from a charitable solicitation purpose or for charitable solicitation purposes? As I said earlier, states are truly increasing their activities or regulation of charities. The state of California, for one of our clients, recently sent out a notice indicating that an organization was, in essence, active in the state of California, but actually not registered. Somehow it came to the attention of the Attorney General's office, and they followed up perhaps to an inquiry or some other way that it came to their attention. Most states may impose fines if you are conducting activities in the state and you fail to register. We had a client recently register in the state of Pennsylvania. New organization, had only been around perhaps for 3 or 4 years, but had been receiving one grant from the state of Pennsylvania in its first few years of existence. And I believe it was year 3 or year 4 that the organization was registered. We submitted 990s along with the registration to the state of Pennsylvania, along with Schedule B that had a contributor listing. The state of Pennsylvania came back and actually assessed a penalty, a fine of $700 per year for each year the organization failed to register. So again, monetarily, your organization may be impacted. Your board of directors have a fiduciary responsibility to ensure that state charitable solicitation compliance is in order, or the responsible parties within the organization may be held accountable. In certain states, it can be a crime, a misdemeanor, and I believe a few states even hold it as a felony to actually be soliciting and not registered within the state. The public is becoming much more knowledgeable, and we find, too, that donors or grantors are becoming more active in the monitoring of charities that they're choosing to give their charitable dollars to. The state of Pennsylvania, if I may use that again as an example, we had a donor at one point in time that was looking at donating to one of our clients who was actually located in a different state, and the donor was in the state of Pennsylvania. The donor wished to give the organization a sizable contribution, but actually went to the organization indicating they would not contribute until the organization was properly registered within the state. So again, proper registration took maybe a week to get the paperwork in, but it was well worth the organization's time to go about ensuring compliance. I talked a bit about the enforcement by the regulators, the state of California, state of Massachusetts, New York, North Carolina is very active in monitoring the charitable solicitations. And then also court actions that state regulators may impose cease and desist orders or initiate court actions against organizations for failure to, in essence, properly register within their state. So again, we go back to first and foremost, in most instances, it's the law within the state. And from a risk perspective, we want to be compliant with the laws and within the states and other jurisdictions that we are currently operating. We talk many times about charitable solicitations, and we think in terms of our requirement as an exempt organization to register as a charity before we actually send out that solicitation. But if we engage professional fundraisers, and the professional fundraiser is in essence soliciting individuals or residents within the state, they too may be required to register. And the failure of your professional fundraiser to properly register, may impact you as a charitable organization. It's interesting because many states have actually taken the definition that a grant writer, if you are writing a grant proposal and you hire an independent third party to write that grant proposal on your behalf, that is technically a professional fundraiser. And if that grant proposal is sent to another jurisdiction, that too may trigger a registration requirement. So again, very simple, innocent activities that our organizations are conducting day in, day out can trigger a registration requirement. When I speak to clients on charitable solicitation registrations, and perhaps it would be the difficulties or complexities associated with it, many times the conversation lands on the cost of registration, because the cost is not inconsequential to many organizations. If you're a large national organization, it may be just part of your normal budget. But for small organizations, it's a significant outlay of time, energy, resources to be compliant. The fees paid to each state vary. It's not a consistent fee. Some states may charge as little as $10, $25, whereas other states may charge thousands of dollars, just the fee for the privilege to be able to solicit within their state. Whether you dedicate internal resources by way of staff time, professional services, if you hire an outside service provider to assist with the registrations or annual compliance, it's not uncommon that, again, if it's internal time or external, that there's a significant portion of time is devoted to this task. Most states require a registered agent within the state. So if, in essence, there is any process serving that is required, that you have, in essence, an agent that can receive that type of paperwork. And then when we look at, especially with internal staff, the lack of uniformity amongst the states creates additional costs. Some states require financial statements to be submitted along with your initial and annual registrations. There may be separate forms. Each state have different due dates of their form. For example, if you're filing in the state of Illinois, their form is due the June 30th for calendar year end, so the last final day of the 6 months following your year end. There may be another extension, 2-month extension, and an additional extension that's available. Whereas if you're in the state of Wisconsin, the form itself is due, or the fee is due to be filed by the 15th day of the 7th month after year end. And there's no separate extension available, no form that you need to file, but the form to request an extension, but the form is due at any point in time. State of California, state of New York follow the IRS due dates, but you may be required to file a separate extension request. So again, it's not always easy to navigate these waters. Compliance itself is a multi-step process when we're talking state charitable solicitations. As Mike and Ellen spoke of when they were talking about other types of tax compliance, trying to quantify and really get your arms around the types of activities is the first step in compliance. Knowing what are the registration requirements within your home state, starting with the state where you're currently domiciled, and then asking the question as far as what activities do you conduct outside of your organization's home state? What activities do you have that may require registrations in other states? If you are sending requests for solicitations to multiple jurisdictions, is that enough to trigger registration? Some states will say no, as long as it is limited. Perhaps it is a handful. Maybe it's the infamous 13 or less, and we aren't required to register. Others will say your first request to a jurisdiction is enough to register. How does the organization utilize social media? Do we have an interactive website, or is your organization's website interactive? The Charleston's principles, which really resulted from the NASCO, the National Association of State Charity Officials, addressing this back, I believe, in 2000 or 2001, really talked about the fact that if, in essence, somebody visits a website and merely makes a contribution through visiting the website, and you as an organization do not, in essence, accumulate names, addresses, telephone numbers, etc., or follow up with multiple solicitations after that initial donation, that one touch is not enough to require you to register where that donor is domiciled. But who in today's world does not have an interactive website? Interactive websites are what we see, and we are continuously seeing clients cultivating that donor base in look for those hard-earned charitable solicitation dollars. And then again, a professional fundraiser is in essence something that may require you to register in multiple states. Many of our national organizations or even local organizations that have a national reach by way of their donor base or their supporters will in essence utilize perhaps a professional fundraiser to help in the solicitation of dollars, and that could in essence require a registration. Registration or compliance, again, is a multi-step process in the sense that first we need to assess the risk. Where do we have the most activities? How do we get our arms around our activities? Do we have some activities that are higher profile than others? Do we have a large fundraising event that we hold in the state of California? What is our risk of noncompliance? Again, we would never advise you not to be compliant, but you need to understand all the risks to your organization before you really start the process of deciding where and how to register. Remembering that almost any solicitation within a state does require registration. And how are we touching those donors? Again, that will add to the complexities of saying where are we conducting our activities. So again, a risk-based approach is really a manner that we utilize in the sense that it assists in determining our exposure of noncompliance. It's not assuring 100% compliance, but it is at least addressing where we believe we have areas of noncompliance within the exempt organization. So once we've determined those states where registration appears to be required based on the earlier steps in the process, you can utilize the Uniform Registration Statement to actually register in multiple states. Almost all states allow for this one form to be completed and submitted to the various states. There may be additional information that certain states will require or additional details, but again, the National Association of State Charity Officials has in essence allowed, or many states have adopted this form to assist in the process. Once you register, some states will say it's just the initial registration that you must be concerned about, whereas other states, most states, take the position that there is an annual compliance requirement in addition to the first registration, similar to what you have from an IRS perspective. You had your first initial determination of tax-exempt status, and then our annual Form 990 filing for each year thereafter. Many organizations will choose to, again, enlist professional assistance if it's legal, accounting, outside boutique organizations that do just this, state charitable solicitation compliance, or designate that internal resource that will be the point person to handle all correspondence and compliance in this area. If you're looking for more information on state charitable solicitations, there's two areas that you can go out and Google. One is the National Association of State Charity Officials. I believe their website is nasconet.org. The other organization is the National Association of Attorney Generals. Both NASCO and NAG have great resources on their website to really assist organizations in the process of state charitable solicitation registration and compliance. It's truly not an easy area to be compliant in, But as I think Mike or Ellen, when they talk in other areas of tax compliance, I would say this is an area that we want our organizations to at least assess the risk, to know where activities are being conducted, and come to a good faith effort to be compliant. So if a state does come knocking at your door and ask questions concerning this type of compliance, you can at least produce that risk assessment that really demonstrated your activities in the state and why you took the position that no, you were not required to actually register for charitable solicitation purposes. I will now turn it back over to Mike Harold, who will talk about another tax area concerning unclaimed property, another area that's of interest to our exempt organizations.
Thank you, Karen. Well, unclaimed property is something that most companies don't even think about, or organizations. It's not a tax, it's a property right. And this is something that's really, maybe a decade ago, we used to hear a lot about unclaimed property, and we still hear about unclaimed property in certain markets. But it's starting to grow again, and we're starting to hear about it more and more. Unclaimed property is the same as what you may have heard is cheat. Maybe you've gone on the website and gone to find your money or missingmoney.com and punched in your name to see if you have money out there, that somebody who owes you money and you failed to collect it, or they didn't send it to you or whatever. That's unclaimed property. Now, unclaimed property hits every business, whether you're a for-profit, non-profit. It affects government. It affects the IRS. If you have an uncashed IRS refund check, that's unclaimed property, and you're entitled to that, and that's supposed to be sent to the state of your residence, and you're supposed to be able to get that money. So unclaimed property, what we're looking at is really an intangible personal property is the key to unclaimed property. It's supposed to be some sort of financial tool, some sort of financial instrument that's out there. Might be a dividend check or some sort of thing like that. Payroll checks, the one we talk about. We have some examples here in a moment. But that's what unclaimed property is. It does have some play when it comes to tangible personal property. You do see cases where tangible personal property, you owning something or holding something that belongs to somebody else, that sometimes has to be turned over to the state too, and we'll talk about that. This is really governed by the states. Each state has their own unclaimed property statutes. They define what unclaimed property is. Most of it is pretty much standardized across the country. There's some variances, like gift certificates. If you have an uncashed gift certificate, you went to Walmart, you bought a gift certificate, you gave it to your spouse as a gift. It was uncashed, they didn't use it, that's unclaimed property. Now the question is, does the state recognize that where that money has to be turned over? Does Walmart have to turn that money over to the state because it's been uncashed, or what happens to it? You have to look at each law, each state, to determine how to handle that. So it's governed by states, and the idea is that if you have some property that belongs to somebody else, you have to turn it over to the state, and the state's going to hold it in trust for you. And they're going to wait for the rightful owner. But really what happens is the states put this money into a general fund. It helps fund state government. They have an escrow account or a reserve that they keep this property in, and they do pay it out. So they identify the rightful owner of the property. They're entitled to get the money, and they will get the money from the state. The traditional types of property that we typically see in unclaimed properties, uncashed checks. And frequently we'll see payroll checks. And an example might be somebody goes and they work at a fast food store. They work there for half a day, and they made it through the lunch hour rush, and they said, this job is not for me. I don't want to be by that deep fat fryer. I don't want to be staying on my feet. I don't want to handle cash. I need a different job. I need an office job. So they leave, and they tell the manager, I'm out of here. Here's my hat. Here's my apron. I'm gone. And they walk out the door. Well, they're entitled to money for that period of time that they were working there. So does the general manager of the fast food store give them some money to compensate them, or do they get a payroll check? This is the type of thing that becomes, if we don't have proof that they were actually paid, that's unclaimed property. It's a right. They were entitled to that right of their money, that payroll, and we have to have proof. We have to have the records that we actually paid them. So that's uncashed checks that we run into, and that comes up often. Might be deposits, like bank deposits that have been left behind. Maybe somebody passed away, for example, and have money left in a savings account. Customer credits, refunds, dormant accounts, retirement assets, 401k plans are really kind of a hot topic right now. Workers' comp, accounts payable, dividends. You might have stock in a publicly held corporation. And did you get your dividend? Did you cash your dividend checks? Maybe you received a dividend, and the way they pay it out now, maybe you have 10 shares and it comes out to $2.60, and you said, I'm just not going to cash that $2.60 check. It's not worth going to the bank and depositing that. Well, that's unclaimed property. If that check goes for 3 years and it's not cashed, that $2.60 now has to be remitted to the state, and under the sourcing rules that we have, it's to the state of your last known address. So now that state gets that $2.60. Your name may appear up on missingmoney.com for a $2.60 check that's being held by whatever your state is. That would be an example of unclaimed property. Tangible property, we do see this in cases. There's been court cases around the country. I think it was New Mexico, Arizona, where a hospital had dentures left behind by a patient. That's unclaimed property. They were supposed to find the rightful owner and turn over those dentures. So, the rightful owner had their property, and really it's to prevent the hospital from being enriched by having these dentures. And, they didn't do it. So they went to court saying, well, there's really no value here. How do you put a value on this? And the courts basically said, we don't care. It's still unclaimed property. It's not your property. You're not entitled to it. The rightful owner was that patient, and they need their dentures back. The hospital said, well, this occurred 10 years ago. We don't know what patient it was. And a lot of times it's jewelry even, a necklace or a ring or something that's left behind. So in a case like that, you still turn it over to the state, and the state holds on to it. And you frequently go online and you see what eBay, where the states are selling unclaimed property. You've got other things, rebates. Maybe you went on that cereal box and you saw a little coupon, mail in 3 proof of purchases and get a $2 back. Well, you took your 3 proof of purchases labels, mailed them in, and you didn't get your $2 check. Again, that's unclaimed property. It's something that you're legally entitled to. You went through the actions. You mailed in your proof of purchase certificates, and you just didn't get your money, so you're entitled to that $2, and maybe they put it to the wrong zip code. It was undeliverable. It was returned back to the fulfillment company. But that's $2 that should go back to your state, and they're going to hold it in trust for you. Again, we talked about uncashed payroll, unidentified cash, credit, other general ledger items. So basically, it's anything that you're holding that you can't track down, that you can't say it's really your property and it probably belongs to somebody else. That's unclaimed property, and you have to be aware of that because nonprofits have to remit unclaimed property. There's 2 states that exempt nonprofits. We'll talk about that in a moment. There are no Nexus rules. So wherever your physical location, you may be located in you might be down in Oklahoma and you don't travel outside the state, but it doesn't matter. If you got property that belongs to somebody who lives in another state, you have to return it to them or that state. So there are no Nexus rules. There's no statute of limitations. Typically, on an unclaimed property audit, the states will go back at least 10 years. And in some cases, they'll go back 20 or 30 years. And the penalties and the interest can be 50% of the property's value, so it can add up quickly. This is the 3rd largest revenue source for the state of Delaware. They collect over $350 million every year in unclaimed property. And one of the dangers is, because there's no statute of limitations, they'll come out there and they'll audit you. And we'll talk about that in a moment. But when they do an audit, they do a projection. So if they audit the past 4 years and they find unclaimed property, they assume that unclaimed property, that proportion of your assets or whatever is going to be unclaimed property, they're going to project that back 10 years or 20 years or whatever the audit period is. So no statute of limitations has a huge bearing on unclaimed property rights and payments. The record retention. Who keeps records from 20 years ago, 10 years ago? And that's the problem that we run into. One of the other problems, very few states have administrative appeals. Once you have that assessment, the only way to resolve it is to go to court. Very difficult, very costly. Nobody wants to do that. It's very, very expensive. And because there are no nexus, you may be appealing in multiple jurisdictions. The use of third-party contract auditors is also a big issue. The states hire third-party auditors. These are auditors who have come out, look for unclaimed property in businesses, state government, various entities, and they get a commission. Typically, it's about a 12 to a 13% commission for all the unclaimed property they found. So just imagine how this applies. You got records that are good for 4 years, but they find unclaimed property during that 4-year period. They project it back 10 years, 20 years. They apply a 50% penalty and interest. There's no appeal rights. It's being handled by a third-party contract auditor who's getting paid 13% commission for all the dollars he finds. And he's going to find everything he can. Everything is presumed to be unclaimed property unless you can prove otherwise. So you don't have the records to dispute the auditor. And these third-party auditors will work for multiple jurisdictions. So you may have a third-party auditor from state A that comes in and does this audit, but while he's there, he's going to call state B, C, D, and pretty soon he's representing all 50 states, looking for unclaimed property for all 50 states and getting paid 13% commission. That's the danger of the unclaimed property. That's how a state like Delaware can go on year after year collecting $350 million in the unclaimed property. One of the other reasons that Delaware, this is a big issue in Delaware, is under the second sourcing rule of unclaimed property, you go back to the headquarters of the state or the state of incorporation, because many corporations decide to incorporate in Delaware. That's how Delaware gets the funds. Plus, they're very aggressive in this area. And again, like I said before, this applies to nonprofits, even the federal and state governments. You might have a Department of Revenue where you overpaid on sales tax. That's unclaimed property, but you got to establish a claim to it before you get it. But again, it applies to everyone. There's limited nonprofit exemptions in Kentucky and Ohio. Otherwise, every state will go after unclaimed property. Once you file, you have to continue to file, even if it's a zero return. There are some steps that you take in the unclaimed property. One, you have to identify that the property rightfully belongs to another. So you have to identify, do you have property that should belong to somebody else? It's property that you don't own, that you're just holding. Then you have to do a due diligence. So basically, let's look at a payroll check. A payroll check. We had our employee who left our fast food restaurant. Now, we may have a bad address for this person. We've tried to mail him a payroll check. He didn't respond. We've tried to contact him. He didn't respond. We had that requirement to try to make contact with this individual and tell him we have some funds, we have some property, and he or she should come in and get this property. If that doesn't happen, now we're in what we call a dormancy period. It's a period where we haven't had contact with this person for a period of time. Payroll checks, it's 1 year. So it's been 1 year. We haven't contacted that employee. He hasn't come in saying, oh, by the way, you owe me for those 5 hours of work. Now what we do is one more thing. We send out a final letter to that employee's last known address. And if the letter's returned undeliverable or we don't have a response from that employee, now we have to take that money and remit it to the state. So if no contact was made within a specific period of time, that dormancy period, that 1 year I just mentioned, now it becomes unclaimed property and you have to remit it to the state. So you send the money into the state, you do a report. A lot of these reports are done electronically now. There's minimum thresholds whether you have to do electronically or not. You try to identify this person, try to identify the property owner. Many times you have no idea who the owner of the property is. And in those cases, you just submit the funds and you identify the property if you can, or else you just simply give the funds to the state. And you have to determine what state gets it. So in the case of the payroll check, under our sourcing rules, I would go to a polling question first. So let's just take a quick polling question. Do you have a process for monitoring unclaimed property? Well, you have three choices. Yes, no, or not yet. So please take a moment and answer the questions. Coin flipping is allowed. Okay, here we go with the answers. Yes, comes in at 39%, 33% responded no, and 28% not yet. So here's some examples of some dormancy periods. So unclaimed payroll check, 1 year. Unclaimed checks from general disbursement accounts, typically going to be about 3 years. Credit memos, accounts receivable, credit balance are 3 years. One of the things that we're seeing are the states need this money. You know, every state, as we talked about before, they want money. So we're seeing these dormancy periods shrink. You know, what used to be maybe 5 years for unclaimed checks from general disbursement accounts are now 3 years. And maybe 2 years from now, they're going to be down to 1 year. So we're seeing these periods of time, this dormancy period, shrinking each year so that the money gets turned over to the state a little bit faster. So the main sourcing rules are, one, the money should go to the jurisdiction where of the last known address of the property owner. So what state was this person? Like we talked about for hospitals in New Mexico who've been taken to court for jewelry and dentures left behind. The presumption is, if you can't identify that patient, we would presume it's probably New Mexico, but we have to look at the sourcing rule. If we don't know specifically the address of that individual, then we go to the place of incorporation. Is that hospital a New Mexico hospital? Are they licensed and registered in New Mexico? Is that the place where they're incorporated? Most likely, then it would go to New Mexico. If we're talking about Walmart and gift certificate, you don't know where a gift certificate's true owner is because this is something you give as a gift. So in a case like that, if Walmart's incorporated in Delaware, that gift certificate, uncashed gift certificate, let's say $50, is now remitted to Delaware. So again, it's the last known address of the property owner. That's the sourcing rules that you have to follow. There's really three rules, but these are primarily the two, and the third one is used very little. So why should organizations file for unclaimed property? Well, Michigan's announced that they're going to be aggressively pursuing unclaimed property beginning the 1st of 2013. There's successor liability issues. That probably doesn't apply so much in the nonprofit arena, but there are problems there. There's officer liability if they do find this. That's another issue that we run into. We're seeing an increasing number of contingency auditors who are out there looking for these funds. Could have material financial consequences. I think one of the biggest ones I remember reading about was something like $250 million for unclaimed property. Now, that's a large financial institution, and they have very strict rules, but they're familiar with it. And there's whistleblower statutes. You have a disgruntled employee who will blow the whistle and be entitled to collect a certain percentage of all the unclaimed property. They contact the state, and the state sends in a third-party auditor who's working on a commission, for example. So these are the reasons that you do want to file, and it's really the right thing to do. You don't want to have your name in the paper for unclaimed property, and you do have to identify these issues pretty closely. And again, that person has to, they have to have a legal right to that property. So you got to make sure it's not like a coin that you find laying on the floor. You have to be able to establish that somebody has a legal right to it. So as I mentioned, some of the developing issues, our dormancy periods are decreasing. We're seeing an increase in audit activity, and there's new property types that are popping up continuously. Health savings plans, traditional IRA, Roth IRA, educational savings account, 401k plans. I was just at a client the other day, and they have 401k funds sitting around where employees have left in the past, and they haven't been able to contact those employees. That's unclaimed property. Now that has to be remitted to the state. And we're just seeing increased legislative awareness in both. It's not only are they looking for the money, but they want to make sure people do have an opportunity to get their money back if it's property that belongs to them. So they are looking at holding this money in trust and returning it to the rightful owner. So again, we have another polling question. Which of the following is most likely to be the biggest issue your organization will face this year? Unrelated business activities, international operations, social media, accounting and auditing standard changes, or executive turnover? Okay, our quick poll results are in. And accounting and audit standard changes are 34%, followed by unrelated business activities, social media, executive turnover, international operations. Just one comment on social media, and I know Karen talked about internet sites. When we're talking about sales tax, I failed to mention you should always be monitoring your internet information to make sure it really captures exactly what you're doing. If you are audited, it applies to everything, even unclaimed property. You want to make sure the information you have on there is accurate because auditors do look, that's one of the first things they look at is your internet site, and they will take that information and use that in their audit results.
Thank you, Mike. With that being said, this would conclude our presentation on various state and local tax considerations for not-for-profit organizations. With that being said, we'd like to open it up to the group if there are any questions you'd like to have addressed. I see we do have a question from the group, a question of what is Nexus? Ellen, could you address that question?
Sure. Nexus is the term that's used to define what is that connection with the state that the organization has that will allow the state to subject them to tax. that's kind of the general broad definition of Nexus. And again, the various activities that the organization performs in out-of-state locations typically is what's going to create what's considered this nexus or connection that allows the state to impose the tax. And that's the first step that an organization needs to go through in order to, analyze what state taxes they're subject to. Because if you don't have nexus, if a state doesn't have that nexus or connection to actually tax the organization, then then there's really no need to go any further. But once you determine there's nexus, then the next step is, okay, what taxes is the organization subject to? So it's the first step in your state tax analysis.
Thank you, Ellen. There was another question that was posed by two different participants, it appears, just asking the question that because the webinar did cover the states, very broadly, not enough time in this, a 2-hour session to really talk about specific requirements for each state. Is there a resource or some place that organizations can go to look at each state's requirements as it relates to sales tax, state income tax, or some of the other tax issues that we have discussed? Ellen and Mike, do you have thoughts on that?
Well, a lot of times clients ask us this. They want a chart that really covers, all taxes. It's really difficult. There really isn't anything out there that would cover everything. The best thing to do really is contact, your advisor and walk through, what your scenario is. And then they can tell you, this is where you have issues or maybe no issues, but they can help you with that. We do have a tool at CliftonLarsonAllen that we use to help organizations and companies evaluate this. It's called a SALT profile tool. And if you haven't had the opportunity to fill one of these out, certainly ask your advisor about it, because what happens is we have our clients or organizations fill these out, and then we analyze them and come back to you with, what maybe additional you need to do. So, please feel free to reach out and ask us for that tool, and we'd be glad to take a look at it and, give you a broad stroke in terms of what we see, if there are any state or local issues.
Thanks, Ellen. There seems to be a question, too, that perhaps this is something that would be addressed to Mike, that the organization is a 501c3 and they occasionally sell pieces of fixed assets or even a vehicle that it no longer needs. Should they be collecting sales tax on the sales? Now, this organization just happens to be located in Arizona, but what about other organizations that have the same types of activities?
Well, particularly when we get to vehicle sales, we have some different sets of rules. Some states have sales tax rules for motor vehicles. Others have general sales tax. Others have specific motor vehicle sales. So you have to see what state you're dealing with, and I'm not sure in Arizona if they have that specific sales for motor vehicles, a different set of statutes. In Arizona, again, is one that have specific requirements. Just because you're a 501c3 does not mean you're exempt. But they do allow for some charities to sell an occasional sale vehicles. So, we would have to answer that, we would have to research it and see. But generally, we do see that there is an occasional sale provision for motor vehicles for charitable purposes, or charities selling it as fundraising.
Thanks, Mike. Another question was posed that addresses charitable solicitations, that an individual works with an organization that's located in Florida, and they have many individuals or members that are part-time residents. And perhaps the newsletter or the ask for a contribution or information is mailed to a northern address in the summer, and then they're in the Florida area for the winter months. Does that or could that mean that the organization may have to register in each of those states? And the answer to that question is yes. It goes back to where is that solicitation made. And if that individual is, in essence, in the state of Florida or in the northern state, in the state of Michigan, and you are sending that to the state of Michigan, we would have to look at, again, the rules for the state of Michigan to indicate how does that impact you as an exempt organization. If you're sending those asks to Michigan, and if you have enough to be required to register, you may have to be required to register with those states. The question was posed, what states do you need to register to solicit? Currently, there are 39 states plus the District of Columbia that require a form of registration before you actually solicit in those states. And depending on your activities in those states, that is what would necessitate or determine if you were required to register. Another question on charitable solicitation is asking that if the organization has a website that's available nationwide, and it does provide the opportunity for individuals to make a contribution regardless of where they're located, does the organization need to register in every state because of that nationwide solicitation? And I'm going to say that it many times may do just that, in the sense that if, in essence, the individuals are donating to you, and you do, in essence, once they contribute, you actually acknowledge that contribution, and then you follow up with additional solicitation requests, as the earlier individual indicated, that you may have a newsletter and other collateral information that's sent to the individuals in that state, that could be enough to require you to register. If you merely have a website and that individual makes a donation and you do absolutely nothing to follow up on, you may thank the individual, but you do absolutely nothing to follow up with that individual with information on your organization or to send additional requests for contributions, then in essence you would not be required to register. Mike, here's a question on unclaimed property. In your accounting records, how do you record the payment to the state of unclaimed property?
Well, that probably goes back through your payables, and I would, because the rules could vary, I would suggest that you do talk to the person who's doing your audit or your advisor and ask it specifically in your situation in your state how you should handle that. But generally it goes back to your payables.
Okay, thanks, Mike. Another question about sales tax and UBI. If their nonprofit organization pays sales tax on a tangible item, linens, that they resell, that is part of a UBI activity, does that take care of their sales tax liability? So if they're purchasing for resale, do those exemptions apply to tax exempts the same as for-profit entities?
Yes, they would. So in a case like this, if you're purchasing tangible personal property that you're going to be reselling, what you do is you give your vendor an exemption certificate, and on your exemption certificate you state you're going to be reselling this, and then you collect the tax on the retail sale, your retail sale.
Thank you. What department of the state usually collects unclaimed property, Mike?
Oh, it comes through a couple different groups. One is, it might be through the Department of Revenue or Department of Taxation. It could be through the Attorney General, but usually it's Department of Taxation or the Commerce Department. It also may be the Secretary of State. The trend is, when you're seeing it through the Department of Revenue or Taxation, that's when you're going to see the state being a little bit more aggressive on the audits. If it's coming through the Commerce Department or a Secretary of State, you're going to see a little bit less audit activity. So it varies state by state, but generally it's going to be between those, and sometimes the Attorney Generals, but more or less the other three.
Okay, thank you. This is a question. I think it's sales tax, but Mike or Ellen, is a not-for-profit is looking at performing administrative services for another nonprofit organization, and the question was raised: is that taxable revenue? Now, I'm assuming that perhaps they mean for sales tax purposes.
Well, for sales tax purposes, we would have to look at that specific state to see if that's one of those taxable services that are enumerated. Could be a state like South Dakota that taxes just about every service. Most states have very few services that are taxable, or a limited number of services that are taxable. So again, to answer that question, we really have to know the state.
Okay, thank you, Mike. Question again concerning charitable solicitations. As a 501c3 organization in the state of Tennessee, the question was raised as to whether or not they're required to register in the state of Pennsylvania if they receive a grant from a trust in Pennsylvania. My answer is you may have to register in the state depending on what you did by way of initiating contact with that grantor, or the trust, I should say, in Pennsylvania. It may be enough that you're deemed to be soliciting in the state of Pennsylvania. Mike or Ellen, is there an efficient way to determine whether the state nexus is based on market or physical presence? I'm thinking this is perhaps an Ellen question.
There are resources, tax resources that will give you, a summary chart that will tell you the sourcing rules. But the unfortunate thing about the chart is it doesn't go into the nuances of it. So, when you get into cost of performance, it could be that if you have your headquarters in one state, and the majority of your costs are in that state, that you're going to source it all to that state. Or it could be pro rata, based on where the performances are performed, looking at each state where they're performed. When you get into the market side, there's all kinds of nuances, and those nuances vary between the different industries. So, I've even been surprised. I'll look at the chart, I'll look at the way the statute reads, and then there'll be an underlying regulation that interprets that for each industry. So, the answer is there are quick and dirty charts, but and so they can give you a general idea, but they're not going to give you the full picture, I guess.
Okay. A couple more questions, and then I believe we'll wrap up because we are right at 4 o'clock. So, Mike, if there's a vendor payment that never cleared and the vendor is not looking for the payment, is that unclaimed property?
Yes, that is unclaimed property. So that money, in a case like that, you should try to contact the vendor, remit the funds, and if you're unsuccessful, if they went out of business or whatever, you would still have to remit that money back to the state because that is a true example of unclaimed property.
Okay. Thanks, Mike. The question was also raised as far as what is the definition of a professional fundraiser, and is it legally defined? For the purpose of state charitable solicitations, the definition of a professional fundraiser will reside in state statute. It's very broad that it is a non-employee that does, in essence, solicit on behalf of another individual. So it can be interpreted very broadly in some states to say it is something as simple as a grant writer, an outside party that you hire to write grant proposals for you, or it could be very narrowly defined in the sense that it has to be an outside company, outside individual who's actually performing themselves actual solicitations. It may be individuals who are assisting in writing solicitation materials, so you're not actually soliciting, but you're helping with the development or consulting with fundraising materials. That too may be a professional fundraiser, but again, it depends upon the state statute. Two more questions is, one question says, if you send a grant request to a foundation in another state, do you have to register in that state? I think it goes back again to a facts and circumstances type approach, that it depends on the activities within the state or how the state defines registrations. So you could be required to register in those circumstances. And with that being said, we can take a little bit of time to answer the final questions, but I'll turn it perhaps back to Nicole for those of you that wish to leave the call. Nicole, do you want to have some final closing remarks?
Absolutely. I just want to thank everybody for participating and for the presenters' time today. We did have some questions come in wondering for CPE if they'll be receiving a copy of the PowerPoint, and the answer is yes. That will be sent to you along with a link to the recording of today's presentation if you'd like to review it for in the future. And also CPE certificates, if you requested it and you met the requirements. That will all be sent to you via email within the next 10 business days. If you need something sooner, please feel free to reach out to me. Also, if your questions have not been answered today, or you want to clarify, please feel free to contact the presenters. I have their contact information up on the screen.
Okay. Thank you. For those of you that do wish to remain on the line, we will answer the final remaining questions. I believe we only have a few left. Mike, during the point in time where unclaimed checks are in the dormancy period, do they stay on your bank reconciliation during that period?
I don't know if I would say that they should be on the bank reconciliation. It depends where the property is really held. If it is something that would be on a bank statement or something, I guess it would stay there. But again, it probably really depends where you have that balance in your books. A lot of times you see separate accounts.
Where would an individual, Mike, find a list of the retention timeframes for unclaimed property? Is there a website where those all may be located?
There are some resources. One, you can go to your home state and find out who's handling the unclaimed property, Secretary of State, Commerce Department, Department of Treasury. They have a chart that gives the holding periods. There's an organization, National Association of Unclaimed Property. They have a website out there. It's kind of it's National Administrators of Unclaimed Property. Their website does have a list. It's pretty standardized. They'll give you all the dormancy periods for all the different states. But if you do go onto the website in your home state, you get it for every state also. And they'll give you the dormancy periods. Again, they do change every year. The time frame does come down, but it'll give you a nice snapshot to begin with.
Okay, thank you, Mike. And again, thank you for everyone. Thank you to everyone for participating in our webinar. As Nicole indicated, CPE certificates and other information will be sent out to you in the near future. Thank you and have a great afternoon.